And if you built an entire economy on spending borrowed money, how are you going to take away the source of that borrowed money? How are you going to deny the ability of consumers to go deeper into debt and assume that we're not going to have a recession when the whole economy is built on debt financed consumption? And it's not just the consumer that's spending borrowed money, it's the government that's spending borrowed money. In fact, the government continues to borrow and spend money. Look, there's a new bill that's held up in the Senate now by Rand Paul, who's one of the few guys in the Senate willing to speak up. But there's a $40 billion aid package for the Ukraine. Now, where's this $40 billion going to come from? Is anybody in Congress talking about what taxes they're going to raise so that we can come up with $40 billion to give to the Ukrainians? Or, hey, maybe we should cut back on some other government spending so we can make some funds available because this is a worthy cause. We need to give $40 billion to the Ukraine, so we have to figure out how to save $40 billion someplace else. No, nobody is talking about where the money is going to come from. Everybody just wants to spend it. Well, where's it going to come from? More debt. Well, we're trying to fight inflation. Every member of the Congress admits that there's too much inflation and we have to fight it. You don't fight inflation by running bigger deficits. The government needs to cut government spending, not come up with more aid packages and expect the Federal Reserve to create the money, because the Fed is supposedly fighting inflation too. Even Rand Paul is pointing this out. Where is this money going to come from? We already have massive deficits. We can't just borrow $40 billion from China. They don't want to lend us any more money. We can't borrow it from the Fed because they're claiming they want to shrink their balance sheet. But will they actually do it? Because who's going to buy these bonds? You know, the bond market got clobbered on Friday, but we still had a gain on the week for bonds. Yields fell on the week. There was a little bit of a reprieve there in the bond market. I think all of this negative economic news, the carnage in the stock market, I think all of that worked to the benefit of bonds, but just temporarily. I think this bear market is going to continue. It's going to be brutal for the bond market. I don't think we're anywhere near a bottom. In fact, one of the reasons bonds were so weak on Friday was because crude oil was so strong. It moved up about $4 a barrel. It closed at 108.43. It was down about $1 on the week, but still, oil held up a lot better than stocks, and the chart looks incredibly strong for oil. I think we're on the verge of another big move up in the price of oil, which is going to be more bad news for the bond market. But as the bond market continues to fall and interest rates continue to rise, we're going to inflict more pain on the economy, more pain at the government level because the government has so much debt, on the individual level, on the corporate level. And as long as interest rates keep rising, stock market rallies won't last. We had a rally on Friday, but the underlying fundamentals that are causing stocks to drop, rising interest rates and a reduction in multiples, a contraction of the price that investors are willing to pay for earnings in the distant future in a new environment of rising interest rates and high inflation, that is going to continue. And you can't collapse the stock market without the economy going into recession, because so much of the economy was built on the foundation of not only the wealth effect of the stock market, but the employment effect. The fact that so many money-losing companies were able to hire workers even though they're not making any money to pay them. The reason they're able to hire workers is because all the cheap money that was sloshing around ended up in their coffers because investors were directing that money to these companies, malinvestments, because they thought they were going to get rich on a stock price going up. And so in the process, all these non-viable jobs got created. Well, a lot of those jobs are about to be lost. They never should have been created in the first place. But once they're lost, there is no job that's going to immediately take their place given what's going on in the economy. And the Fed is going to be staring not just at a recession, but a depression and the prospect of an even worse financial crisis in 2008. Does anybody really think in that environment the Fed is really going to be talking tough about fighting inflation, when as far as it's concerned and everybody else in Washington is concerned, it's got a much bigger problem on its hands and it's willing to accept inflation as a trade-off to trying to solve the more important problem of a collapsing economy and fending off another financial crisis? And again, as I said in my last podcast, Powell doesn't admire Paul Volcker because he had the courage to do what's right. He just admires him because he had the courage to do what he believed in. And I don't think Jerome Powell has the same set of core beliefs as Paul Volcker. I think he has a different set of beliefs, and he's going to act on those set of beliefs. And that means not sacrificing the short-term economy, not allowing a recession, but doing everything in his power to try to mitigate one or postpone one. And if that means much higher inflation, then that's exactly what Powell is prepared to do. And as an investor, we need to be prepared for that, and we need to recognize the fact that so many people now still don't understand this. They still are not able to see through this little mountain to the valley on the other side, and that valley is full of inflation. And just like investors were making a mistake 6 months ago and they were overpaying for these momentum stocks because they thought the prices would keep going up, well, they're making the same mistake with respect to gold and silver mining stocks. They're selling them when they should be buying them, just like they should have been selling these momentum stocks and these tech stocks last year. Instead, they bought them. They're making the same mistake because they still can't see into the future. They're still focused on a narrow window of what's going on without being able to process what comes next or connect these dots. So that just creates an opportunity. A lot of people had an opportunity to unload their tech stocks and their meme stocks and their cryptocurrencies because the consensus was that these prices would keep going up. Well, now you have the opportunity to buy what a lot of other people are selling. All the people who were surprised by inflation, who didn't think inflation was coming, who now think that if the Fed is going to be able to get rid of it, they're wrong again. They were wrong in not recognizing the threat of inflation, and now they're wrong to accept the Fed's BS that it's able to combat it. It's not, but that does give people who don't own these stocks and gold and silver an opportunity.